In 2026, renting can be the smarter financial move, even if you can afford to buy a house. That sounds wrong, because we are taught that rent is wasted money and a mortgage builds wealth. But look at the math. In July, the median existing home in the United States sold for about $434,000. Put 20% down, and you need nearly $87,000 before closing costs. Finance the rest with a 30-year mortgage at roughly 6.67%, and the principal and interest payment is about $2,234 a month. And that is not the real monthly cost. Add property taxes, homeowners insurance, maintenance, possibly homeowners association fees, and the money tied up in the down payment. Now compare that with renting. Zillow says the typical U.S. asking rent was about $1,965 in June. Nearly 40% of rental listings on Zillow were also offering some type of concession, such as free rent, waived fees, or parking. This is not a perfect comparison. The typical rental and the typical home for sale are not identical properties, but it shows why the old rule that buying is always cheaper no longer works. There is another surprise inside the mortgage payment. Take that same roughly $347,000 loan. On the first monthly payment, about $1,930 goes to interest. Only around $300 goes toward reducing the loan balance. Yes, the amount going to principal slowly increases over time, but early in a 30-year mortgage, a huge part of the payment is the cost of borrowing the money. So renting is not the only way to spend money without getting equity back. Homeowners also spend money on interest, taxes, insurance, repairs, and transaction costs. The real question is what you get in exchange. Buying becomes much more powerful when you stay long enough. Your principal balance falls. You build equity. If the home rises in value, you participate in that appreciation. And with a fixed-rate mortgage, the principal and interest portion of your payment does not rise just because market rents do. But time matters. Buying a home and selling it 2 years later can be expensive. There are costs when you purchase. There can be costs when you sell. And if the home barely appreciates, those costs can consume much of the equity you managed to build. That makes flexibility valuable. A renter can usually move more easily for a better job, a relationship, a cheaper city, or a larger home. A homeowner may have hundreds of thousands of dollars attached to one property in one location. Then there is the down payment. That $87,000 does not disappear when you buy. It becomes home equity. But it also stops being available for other uses. A renter who keeps a smaller emergency fund and invests the difference could potentially build wealth outside real estate. The important word is could. That only works if the renter actually saves or invests the difference instead of spending it. And buying has advantages that are not visible in a spreadsheet. You control the space. You can renovate. You are not negotiating a lease every year. You may value stability more than flexibility. For a family planning to stay in the same area for a long time, those benefits can be worth paying more up front. This is why the rent versus buy argument becomes misleading when people try to declare one permanent winner. The answer changes by city. In some markets, home prices are relatively close to local rents. In expensive coastal cities, buying can cost dramatically more each month. Mortgage rates change the equation. So do property taxes, insurance, maintenance, expected rent increases, home appreciation, and how long you plan to stay. Even the same person can get a different answer 5 years apart. So here is the better way to think about buying a home in 2026. Do not ask whether renting is throwing money away. Ask how much each option costs you for the life you actually expect to live. If buying forces you into a much higher monthly payment, drains your emergency savings, and you may move within a few years, renting can be the financially stronger choice. If you can comfortably afford the full ownership cost, plan to stay for years, want stability, and the local numbers make sense, buying can become extremely powerful. A home is both a place to live and a financial asset. That is exactly why the decision should not be emotional. In 2026, buying is not automatically the adult move, and renting is not automatically losing. The smarter choice is the one whose math still works after you include everything people usually leave out.